Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Credit Risk Mitigation. Credit risk mitigation is an essential aspect of credit risk management, crucial for financial institutions to sustain their operational viability and profitability. This lesson aims to provide a thorough understanding of the techniques and strategies used to mitigate credit risk, which is the possibility of a loss resulting from a borrower's failure to repay a loan or meet contractual obligations. Effective credit risk mitigation can significantly reduce the exposure of banks and financial institutions to potential losses, thereby maintaining financial stability and fostering market confidence. Credit risk mitigation encompasses a variety of methods, each with its own set of advantages and limitations. One commonly used method is collateralization, where the borrower provides an asset as security for the loan. Collateral can take many forms, including real estate, cash deposits, inventories, and securities. The primary advantage of collateral is that it provides the lender with a tangible asset that can be liquidated in the event of a default. However, the value of collateral can fluctuate, and in some cases, it may not cover the full amount of the loan if the asset's market value decreases. Diversification is another fundamental principle in credit risk mitigation. By spreading credit exposure across various borrowers, industries, and geographic regions, financial institutions can reduce the impact of any single default on their overall portfolio. Diversification reduces the unsystematic risk, which is the risk specific to individual borrowers or sectors. However, it does not eliminate systematic risk, which affects the market as a whole. Credit risk mitigation also involves the use of credit insurance. This type of insurance protects lenders against losses resulting from a borrower's default. It is particularly useful for trade finance and international transactions, where the risk of non-payment can be higher due to geopolitical and economic factors. Credit insurance policies can cover the entire value of the transaction or a portion of it, depending on the terms agreed upon by the insurer and the insured. Covenants are another essential tool for mitigating credit risk. These are clauses included in loan agreements that impose certain conditions on the borrower, such as maintaining specific financial ratios or restricting additional borrowing. Covenants serve as early warning mechanisms, allowing lenders to take corrective actions if the borrower's financial health deteriorates. While covenants can be highly effective, they require continuous monitoring and enforcement, which can be resource-intensive for financial institutions. Guarantees and letters of credit are also widely used in credit risk mitigation. A guarantee is a promise by a third party, usually a parent company or a government entity, to fulfill the borrower's obligations if they default. Letters of credit, on the other hand, are issued by banks to ensure that payments will be made to the seller under specified conditions. Both instruments provide additional assurance to lenders, reducing the likelihood of loss. However, the effectiveness of these tools depends on the creditworthiness of the guarantor or the issuing bank. The application of credit scoring models is another critical aspect of credit risk mitigation. These models use statistical techniques to evaluate the creditworthiness of potential borrowers based on various factors, including their credit history, income, and debt levels. By accurately predicting the likelihood of default, credit scoring models enable lenders to make informed decisions and set appropriate interest rates and credit limits. Notable models include the FICO score and the Altman Z-score, both of which have been extensively validated and widely adopted in the industry. The importance of regulatory frameworks in credit risk mitigation cannot be overstated. Regulatory bodies, such as the Basel Committee on Banking Supervision, have established guidelines and standards to ensure that financial institutions maintain adequate capital reserves and adopt prudent risk management practices. The Basel III framework, for example, introduce stricter capital requirements, leverage ratios, and liquidity standards to enhance the resilience of banks in the face of financial stress. Compliance with these regulations is crucial for mitigating credit risk and maintaining the stability of the financial system. Stress testing is another valuable tool for credit risk mitigation. This process involves simulating various adverse economic scenarios to assess the potential impact on a financial institution's credit portfolio. By identifying vulnerabilities and estimating potential losses, stress testing helps institutions develop contingency plans and strengthen their risk management practices. Stress tests have gained prominence in the aftermath of the global financial crisis, with regulatory authorities mandating their regular conduct to ensure the robustness of the banking sector. The role of technology in credit risk mitigation has also become increasingly significant. Advances in data analytics, machine learning, and artificial intelligence have revolutionized the way financial institutions assess and manage credit risk. These technologies enable the analysis of vast amounts of data to identify patterns and trends that may not be apparent through traditional methods. For example, machine learning algorithms can enhance credit scoring models by incorporating non-traditional data sources such as social media activity and online behavior to provide a more comprehensive assessment of creditworthiness. In conclusion, credit risk mitigation is a multifaceted endeavor that requires a combination of strategies and tools to effectively manage and reduce the exposure to potential losses. Collateralization, credit derivatives, diversification, credit insurance, covenants, guarantees, letters of credit, credit scoring models, regulatory frameworks, stress testing, and technological advancements all play crucial roles in this process. By adopting a holistic approach to credit risk mitigation, financial institutions can enhance their resilience, protect their profitability, and contribute to the overall stability of the financial system. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.